Welcome to the November update on the Hopkins Group Managed Discretionary Account portfolios. It was a busy month in the investment committee this month. We had some serious discussions about what the right approach was for the investment portfolio. There's been some real change in the markets over the last month, in that it feels like central banks are coming to the end of their tightening cycle. Perhaps inflation starting to show signs that it's going to retreat and fall back. And economically, things are performing pretty well, and company earnings have been pretty strong. So, with that in mind, we've made some adjustments to the portfolio this month and some significant changes. The main change, I guess, has been that we are reducing our negative tilt we've had a defensive tilt in the portfolio, which we're looking to bring back to a more neutral position. And while it's really difficult to time markets, we feel that the portfolio has done its job of being defensive at a time when markets have been really down and really negative. And so moving back to a more neutral tilt will allow us to position the portfolio so that, if economically things do take off and it recovers well, we're going to get the benefits of that. And even if things, sort of track sideways for a little while, we're also going to have that broad exposure, to those markets as well, and that we're going to get good income from the portfolio while the market takes time to recover. So what the main sort of changes for this month are: we've been able to get access to a portfolio of index funds which have no management fees, and that's been a recent addition to the platforms, and so that's been the main change, and we've had some changes. So we've moved some Vanguard sort of index funds that we've owned to these zero cost index funds, and between that we think it's going to save about 5 to 10 basis points on the portfolio. And costs are an important feature of having portfolio construction, and if we can keep the costs down without any change in performance, it's a natural objective to do that. The other major asset class changes that we've done is reduced our exposure to infrastructure assets from about 8% of the portfolio to about 4% of the portfolio. And we've also reduced our exposure to private equity, which had both of those two asset classes have been really important in keeping the defensive nature of the portfolio that we've had over the last 9 to 12 months. With that asset allocation, we've also reduced our exposure to the gold and the gold mining companies within the portfolio. Just feeling that that the gold potentially, with interest rates where they are, is not as an attractive inflation hedge as it once was, and it's costing us more money by having those gold exposures because they're not producing income from that position that we'd otherwise get. To compensate that, we've increased our exposure to both Australian and international shares, which again, now when we're in a position where we've had this sort of correction, the companies are going to pay sort of good income from the portfolio. So even if the market tracks sideways, we're probably going to get a superior return from those investments than we would have previously. Within the fixed income part of the portfolio, we've also had a very floating rate holdings in the portfolio, which means that as interest rate rise, we get the benefits of those rises. And now we're sort of getting a feeling that maybe central banks are peaking in their rising of interest rates, which means that we're moving to a more fixed rate focused. So if interest rates are peaking, that we're going to get those fixed rates, which is going to benefit us should interest rates start to turn down. But also, even if not, we're getting a decent income from those investments, which we think is going to compensate us, even if we're slightly wrong in terms of the market timing. We're going to get that solid income from really solid, government issuers, the Reserve Bank and the Federal Bank and the like. So, we're moving to a more, the fixed rate component within that fixed income portfolio. Within the investments, we've made some changes. We've changed a couple of asset managers, sort of moved money out of Firetrail and allocated that broadly to more index focused, and being index focused, and if markets are going to rally, having the index generally works better than an investment manager. And we've been pretty disappointed with Firetrail, obviously, the performance that they've had, and just sort of think that moving back to a more broader market exposure is going to provide a great deal of diversification, but also giving you that upside exposure when markets rally. Within the Australian small caps as well, we've increased our allocation to both OC and Novaport, which again, bringing that back to a more neutral position. We were underweight small caps while the market was going down, which has really been beneficial for your portfolio. But now we're sort of bringing it back to a more neutral position, and perhaps in time, once we gain more confidence that the rally is going to be sustained and potentially we're at the start of a new bull market, we'll increase that exposure to those small caps at that time, because they are a great proxy and a great way to add benefit to the portfolio. Within the international part of the portfolio, we've moved out of MFS and moved into more index, and again, within the international component, I think I mentioned it last month in the video that we were looking at reducing or increasing the hedging of the portfolio, and we're certainly increased the hedging. And the reason for that is, again, that perhaps the US is starting to show signs that they're topping out on their interest rate rises, and that the dollar in the US will likely to come down against the Aussie dollar, and to protect some of that portfolio, we've introduced more hedging than we currently have. So we've moved sort of from a 30% hedging to a 50% hedging within the portfolio. And the other big change is that we're bringing back a more neutral allocation to emerging markets, which again have performed really poorly. China's the main part of the emerging markets complex, if you like, and we've done that because there's had that 5-year Congress. There's certainly some expectations that the lockdowns within China are going to cease at some stage, in the first quarter, the first half of next year, which should obviously see the economy strengthen up as it has done in the Western world. And if that's the case, obviously China's going to be a major beneficiary. And the reality is that they're just cheap. Like Chinese equities compared to the rest of the world are just cheap, and while China is only a component of emerging markets, we also like India, which is the other sort of major emerging market economy there that's going to benefit from that. So we've brought the emerging market portfolio back to neutral, and we brought, generally over the whole portfolio, we've brought it back to a more neutral stance, and allowing us to obviously benefit if the markets pick up, even though we don't expect the economies to pick up. If markets pick up, we'll get that benefit of that, but also just to provide a really good income and greater diversification within the portfolio. So, it's been a big month, and certainly you'll see some real changes within your managed discretionary account portfolios. But certainly, we're looking through to 2023 to deliver continued strong performance from the managed accounts portfolios.